Fundamentals are important, but it doesn't always go into the stock price. Take a look at this market update. Two things we recommend that both fundamentally doing well. One price is doing exceptionally well, the other one is lagging. Hi, Jim Gore from THOR Wealth Management. Well, in this update, I'm going to be talking about two investments that we recommended within the last year. And even though both of them are fundamentally doing well, one is being reflected in the price of the securities, the other one is not. Let's first look at the good news. And we did this in this market update earlier this year. We talked about gold mining stocks being a very good investment. And you can actually see here, this is looking at the GDX, the large gold miners, versus actual gold prices. And you can see here, especially at the end, that this has performed very well in the last year. However, for the first 4 years, it didn't perform well. Actually, you can see even though gold was up 40%, gold miners were up 0%. They have caught up in the last year, and you can see that really big move here at the end. So people say, hey, wait a minute. Is this the end of the gold miners' performance here? We don't think it is. And the reason for that is you look at gold relative to gold miners, the price, they should be selling 1-to-1. And if you look at this chart historically, gold miners were very, very expensive. They're 1.2, 1.9 back in 2006, 2007, and the companies were fundamentally different than what they were today. Back then, they were basically people running it just saying, we're going to get gold at any price. They weren't run as businesses. However, you saw that crash, and gold miners do extremely poorly relative to gold. And 2016, they were very cheap. But notice, they've remained cheap. And even today, even with this move that we've had up here, we've only gone from the basement, maybe halfway up the stairs to the first floor with gold miners versus gold. So if you're going to invest in gold, you definitely do not want to invest in gold itself. You want to invest in the miners. And the reason for that is the earnings of these companies are going up pretty dramatically. And you can see that from this chart. This is a chart that we used in our update earlier this year. And this is looking at how much it costs for the miners to get it out of the ground. The average cost is about $1,500. And here, back in this chart, when we use this, at the end of the year, we were under $2,500 an ounce. It's $3,600 an ounce now. So back then, they were making $1,000 out of every ounce. Just now, because of the year, the gold has gone up here, you're now getting $1,000 more. You're getting $2,000 in earnings off of the gold that you're getting per ounce instead of $1,000. That's a 100% increase in your earnings. Well, that explains why gold miners are up quite significantly this year, but that's why they're going to continue to grow, is because they're making those margins. They're making good returns for you as an investor. Now, one area that hasn't performed as well this year, but fundamentally is doing strong, is the MLPs. And we did this market update back at the end of the year last year. And I used this chart. We've liked MLPs since 2020 when gold or oil was at zero or negative. No one wanted to buy the MLPs, which are master limited partnerships, midstream pipelines. And we showed this performance, how they did over that time period up until we did the market update. And you can see they did much better than the market. And we talked about, we think sustainability, they're going to do well for the future. But actually, they've lagged a little bit here performance-wise, but it's not because of the fundamentals. And let me show you why that is. If you look at what these companies are earning and what I'm getting as an investor, especially in a time period where we're seeing interest rates coming down on a short-term basis, I want an investment that's paying me income but growing. So if you look at this, this is historically looking at the yield, the growth that you're getting in the distributions coming out to you, as well as buybacks. You go back, you did not have buybacks whatsoever in the MLP space until really just recently in the last 4 to 5 years. They're buying back shares because they're so cheap. Before that, you really had no buybacks. And so these companies are buying back shares. So I'm getting a 13% return on my investments in MLPs. I'm getting my distributions are growing. My yield is 7%. These are still a very good investment, especially in an environment that you might see interest rates come down. Fundamentally sound. But the other thing that has really fundamentally changed in the MLPs is their debt structures. If you go back before, in 2000 and 2009, MLPs were highly leveraged and they were borrowing money and giving higher distribution rates out. Well, that stopped. You're seeing the distribution growth go up, but they're buying back shares, but they're also reducing their debt. Look at their debt levels. On average, it's been 3.8 times their EBITDA. Now we're at 3.2, 3.1. So these debt levels are coming down. So the companies are stronger than they've ever been. You're getting great dividend yield and you have dividend growth. MLPs have been middling. They really haven't grown at all this year, but fundamentally and company-wise, they are, and we think that will catch up with the price probably next year. We're just taking a breather now, but next year you'll probably see MLPs perform very well, especially if interest rates start coming down. If you have any questions or concerns, as always, reach out to us at THOR Wealth Management or give us a call. Take care and talk to you in a couple weeks. Subscribe to the THOR channel today.